If you walk down a typical high street today, you won't see many small, independent shops. Instead, you're surrounded by massive, recognizable corporate brands. Operating on a limited scale leaves a company vulnerable to sudden market shifts. To build a defensive advantage, businesses often prioritize achieving economies of scale. This chart shows economies of scale. As production volume increases, usually by buying bulk raw materials, the unit cost drops. With low unit costs, you can undercut smaller rivals with cheaper retail prices, or match their market price to pocket a larger profit margin. Because of this math, achieving economies of scale makes business growth a survival strategy. Every business owner eventually has to choose whether to build their empire naturally from the inside or acquire it from the outside. Internal or organic growth happens when a business expands naturally. They scale up their operations entirely on their own, without merging with or buying out any other companies. A company achieves this by launching a new line of products, by hiring more staff to boost their output, or opening brand new stores to reach customers in international markets. To pay for this expansion, they rely heavily on retained profits. This is the surplus money the business has generated and saved up over time, rather than paying it out as dividends to their shareholders. This method carries a distinct trade-off. By growing organically, a business maintains complete control and preserves its original values. However, the return on that investment can take years to materialize. For businesses that cannot afford to wait, there is external growth, also known as integration. This starts with a friendly merger, where two companies agree to combine forces on equal terms, instantly scaling up their operations. But integration isn't always friendly. In a takeover, a larger company forces a hostile buyout. They swallow the rival business entirely, often erasing its original identity in the process. When two firms operating at the same stage of production combine, it's called horizontal integration. By acquiring a direct competitor, like one major supermarket buying another, a company immediately eliminates rivalry and increases its total market share. If a business wants to secure its production pipeline, it uses backward vertical integration. This happens when a company reaches back to take over its own supplier, guaranteeing a steady flow of raw materials. Conversely, forward vertical integration is when that same business takes over a company at a later stage of production, like a retail outlet. This cuts out the middleman, giving the parent company control over how the product is priced and displayed. Then there is diversification, which creates a corporate conglomerate. This happens when a business expands into different markets, like a consumer electronics brand building heavy industrial ships. It spreads their financial risk so that a failure in one market can be compensated by success in another. External integration unlocks economies of scale quickly, but it comes at a structural cost, frequently triggering internal culture clashes and severe job losses. Buying a competing corporation requires enormous capital. If a business doesn't have enough retained profit in the bank, they have to find other ways to fund the acquisition. One strategy is divestment. A parent company will sell off one of its existing subsidiary businesses or large assets to quickly raise a massive injection of cash. They also use outsourcing. By paying specialized external firms to handle non-core daily activities, like IT networks or catering, the main business frees up both its operational focus and its cash flow. A more predatory method is asset stripping. This is when a corporate raider buys a struggling company solely to auction off its valuable machinery, real estate, and equipment piece by piece to generate a profit. To understand how a business empire operates, you have to look at how they manage capital, sell subsidiaries, and strip assets to fund their next phase of growth. The banks and retailers on the high street are the results of long-term corporate strategies. These brands are the surviving entities of decades of integration and internal reinvestment. Every method of growth carries a specific weight. Internal reinvestment preserves the company's control, but moves slowly. External integration secures dominance, but invites significant structural risks. Bigger is not automatically better. Scaling up too fast organically can lead to the hiring of inexperienced staff, while aggressive integration often triggers internal hostility and massive job losses. The next time you interact with a global brand, look past the logo. Identify whether they grew their empire organically over decades or integrated to swallow the market whole.